And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Wednesday, it's hump day, and it's also September 24th. I mean, we're about to wrap up the month. Halloween is here already, at least at my house. Decorations are out. Yeah, and I got a TikTok from my wife yesterday, right? That says, you better bet that October 31st, Christmas trees are going up. So she was so excited yesterday. She ordered these big Christmas ornaments.
The inflatable ones?
No, they just expand.
Oh, okay.
But they light up inside. They have lights inside, so she's been hanging them all in front of the house. Where it looks like Chinese New Year. So, but she's all excited. This is her time of the year, right? Yeah. She lives for this time of the year.
And this year, even more so.
Yeah, exactly.
Yeah.
Exactly.
Good for her.
Absolutely. Anyway, so a couple of things going on this morning. When we take a look at the recent economic, we're going to talk a little bit more about this morning, but there's a very interesting dichotomy going on within the economic data right now. Some of the data is okay, right? Says the economy is doing just fine. GDP right now expected for second quarter to be around 2.2% growth. So again, the economy is doing okay on the surface, but there's a lot of other indicators that suggest that, well, maybe not so much. And again, we take a look at ISM manufacturing and services are weak. Leading economic indicators are negative. So, why this divergence? Well, it comes down, I posted this chart this morning on X. If you go to our X account at Lance Roberts, you can see this chart, but it's all tech spending. They did some analysis this morning at Goldman Sachs showing that ex-tech spending, the economy would be very close to recession. So it's all this, we've talked about before, all this data center build out, all of the kind of push by technology companies, these hundreds of billions of dollars being spent into CapEx. You've got CoreWeave investing $100 million into Oracle, which is investing $100 million into NVIDIA, which is investing $100 million back into CoreWeave. And so you got this whole little circle going around of money flows of companies investing in each other, building stuff out. That's all providing for economic growth, right? On the surface. But for the vast majority of the economy, there's a lot of weakness. So the question is which one's going to win out ultimately, and particularly as we go into next year, because Wall Street is betting on an economic resurgence, that all of a sudden this weakness that's in the rest of the economy is going to turn around and begin to reaccelerate. And maybe that's the case, but you need a catalyst for that. What's going to be the driver to get consumption and these type of things kind of for the broad base of Americans to start growing again and get us back up. So again, when you take a look, and we'll go through some charts this morning, but that tech spending that we've talked about here on the show, again, that's a lot of the support that goes in there because there's a lot of monetary multiplier effect of that type of spending on the economy because it's more infrastructure, building out these data centers, et cetera. But it is having impact, and we are seeing it in the economic data. But it's a very bifurcated set of data. Again, when we start talking about these, like leading economic indicators, inverted yield curves that are now uninverted, typically a recessionary sign. Hey, there's no recession, but there's also no resurgence either. So it's just kind of an interesting thing because this all comes back down to earnings ultimately and forward valuations. And forward valuations right now just eclipsed the highest level we've seen since 2021, and that's now the second highest level on record going back to the dot-com crisis in 1999. So, valuations are very rich as investors are continuing to bet that forward earnings are going to catch up with current valuations. In other words, justify the valuations that people are paying today for stocks. And particularly in some of the more high beta names, again, as we talked about before, a lot of risk on in the markets. Lots of beta chase right now, and that's okay as long as everything remains kind of status quo. Any hiccup to this is going to be problematic as we kind of go forward. But here's what you need to know before the bell this morning. Yesterday, markets, it's kind of weird because markets were red yesterday, and I know that doesn't ever happen anymore. Fortunately, futures are up this morning, so whatever little bit of sell-off we had yesterday is going to kind of rally back today. But we did see a little bit of a sell-off yesterday. No big deal. Markets are overbought, kind of worked off a little bit of that overbought condition. Again, futures are set to point higher this morning. Really no news to speak of at this point, but kind of the sell-off yesterday was Jerome Powell's Alan Greenspan moment. Now, I know a lot of you listening to the show this morning aren't old enough to remember Alan Greenspan, but way back in the day, before the turn of the century, there was this Fed chairman called Alan Greenspan. And he said that stocks are irrationally overvalued. And of course, this was about 1996, and markets just kept on going higher until we got to the dot-com bust. Well, Jerome Powell yesterday said that stocks are richly valued, and that kind of caused a little bit of concern, a very brief concern in the markets. And again, everybody's like, okay, stocks are overvalued, I'll sell some today, buy back tomorrow, and that's what they're doing this morning. But again, Jerome Powell saying stocks are richly valued here, and he's right. And if we take a look at valuations really across the board and what people are paying for stocks, they are richly valued on multiple fronts. But again, nothing really wrong with that for right now. The trend remains very positive. Technically, there's no signs of distress, nothing to be overly concerned about. But again, we have these very big gaps between where markets are currently trading and the moving averages below it. Those will eventually close. The question is what causes it when, which is why it's important to continue to navigate your portfolio and manage risk accordingly. But right now, there is nothing disrupting the markets to a large degree. There's no real big concern. There's no upcoming data that looks to disrupt the market at the moment. So again, it's okay to continue to kind of ride this market, but just be very aware that we've got very, very compressed volatility here. And the problem with compressed volatility is that that's what gets you into trouble from time to time. And we are starting to see volatility creep up here very, very slightly. Again, not a warning sign just yet, but that increase in volatility, and you're on a buy signal right now, that something breaks in the market, you're going to get a very sharp pop and a very sharp sell-off in stocks. So that's why I just continue to manage risk here accordingly. Doesn't mean, be overly bearish, but there are some kind of underpinnings of this market that could lead to a very sharp reversal. All right, that's what you need to know before the bell this morning. We'll come back with Danny Ratliff, talk a little bit about recessionary indicators. I got a couple of interesting charts to share with you this morning, so don't go away. More coming up on The Real Investment Show.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Danny, good morning. How are you?
Morning, we're doing great. You?
I'm good. So you want to talk a little bit about strange recession signals this morning. What markets and odd indicators are telling us.
Well, I think we are in an interesting situation right now, and you just kind of just alluded to it, right? Markets have been at highs. We've been elevated for a while. If we look back at all of the data that's out there, and in fact, a discussion we've been having often with clients is that if we would have put together a list, and often we can make a pros and cons list of what the market looks like, the things that are occurring or what we think may occur, and the market doesn't care. But, I think there's a lot of people who are stuck. And what I mean by stuck is that they don't know exactly if they're sitting in cash, should they invest? If they're in the market, they've done extremely well, do they take some profits? You discussed this just a moment ago. Mm-hmm. But a lot of these indicators have been going off for a significant period of time, yet the market continues to roll. And it's been extremely resilient. And so I wanted to talk with you about maybe some of the things that we should be looking for, and then what should we really take with a grain of salt? Because right now the markets just don't seem to care about much.
No, that's right. They don't.
So throw them all out, right?
Right. Right now, that's absolutely the case.
Yeah.
Because it does. I mean, it doesn't matter until it does. And the problem with, again, for most investors is they began to, try to extrapolate that, oh yeah, this is definitely going to happen, so I'm going to get out of the markets, and the markets keep running, and then eventually they get sucked back into the market because it's like, well, the market's just never going to go down again, so now I get in, and that's typically right where the top of the market is.
Yeah.
Because the market, look, I wrote this in an article that that's coming out, I think on Monday or Tuesday, but Mark Spitzenagel, he wrote this really great piece. He says, the markets are mean. They do everything they can to suck investors in just to take all their money away from them. And he's right.
Well, we had a discussion not long ago talking about people wanting to get into the markets, but waiting for this biggest recession or the big drawdown. And you made a comment that, a lot of people say that actually more money's lost by not being in the market leading up to even that drawdown. But the problem is like you mentioned, people get sucked in here at the last moment. So, talking about what are the mainstream indicators, some of the things that we watch for, and, I think everybody does. And the most mainstream is probably what? Leading economic index, the yield curve, but and probably more historically accurate. Yet those have been flashing yellow lights for quite some time. And we're well extended on what we would have typically seen from a recession of what they would have historically indicated. We haven't seen it. And so I think that's what's throwing a lot of people for a loop, is that, not to mention that, everybody has a microphone now, and everybody has a thesis, and everybody is trying to sell something. And so we get all these narratives that I think make almost the paralysis by analysis type of situation, because we can think of all those negative things that are going to occur, yet those just aren't happening. So, right now, looking at leading economic index or even the yield curve, which was inverted for a significant period of time, there are still some that are inverted. Historically, you would say on average, you'd see a recession in 15 months, give or take?
Yep, normally 15 to 24.
Yeah, and we're well past that, very extended.
Again, people have been calling for a recession since 2023.
Yeah.
And, we had a negative quarter in the first quarter of this year. Everybody's like, oh, recession. Was like, no, it's not a recession because this has everything to do with just tariff front running. And then, of course, we had that huge growth in the second quarter, which was all due to the reversal of the tariff front running because of Liberation Day. And so now we're kind of normalizing economic growth around 2%. But again, an economy growing at 2%. But this is the chart I was talking about during the opening. This is economic growth with and without tech spending. And this is kind of the point that I was making, is that you can see that 2.2% growth in tech, the 2.2% growth in the economy that's estimated right now is all coming from tech spending. If we didn't have that technology spending on AI data centers, et cetera, we would be closer, much, much, much closer, if not actually pending kind of a recession. And notably, and I'm gonna give you one more chart here, Brent. This is a global PMI indicator. So this is purchasing managers indexes on a global basis. And again, when you take a look at prices, backlogs, inventories, trade orders, now this is all of the kind of the global indicators. So this is worldwide, not just U.S. They're all sitting at really kind of recessionary territory. And so you're going, okay, well, what's going on here? Well, we go back, and a lot of that has, again, you take a look at the broad swath of the economy. Take a look at earnings as a good example. Earnings are coming from basically 10 stocks in the S&P index plus financials, and every other sector of the market is not generating earnings growth to any great degree. And that's what's really happening. And importantly, there's a big chase for small and mid-cap stocks right now, which are very, very economically sensitive. Everybody's betting on this big resurgence in the economy. They're chasing a lot of stocks on a meme basis because they are thinking that these tech stocks in the small cap space are going to be the next NVIDIAs, the next Googles, the next whatevers. But these are very, very sensitive to economic changes. And when you don't have a lot of economic growth, that becomes more problematic. And this is a chart of CapEx spending. So this is CapEx utilization rates, which have been declining really ever since 2022. Another sign the economy is slowing down. When capex should be capacity utilization should be expanding if the economy is growing. If it's contracting, the economy is not growing that fast. Now, the blue line in the back is an inverted unemployment rate. And you'll notice that there's a decently high correlation to sharp downturns in capacity utilization rates. So if we begin to see capacity utilization drop off sharply here, that's going to coincide with a big surge in unemployment. But again, this certainly doesn't suggest that the economy is firing on all cylinders. But again, it's also not recessionary either. And so that's kind of the big conundrum.
So what other indicators do you think that people should be following right now outside of looking at?
I don't know. You were the one that sent me the article this morning.
Yesterday, you shouldn't have done your homework.
So tell me what you got.
Well, I mean, in general, the big things are going to be rising unemployment rate, obviously corporate earnings declining, stock market declines, declining GDP. And, you just mentioned if you extrapolate tech out of the equation, growth doesn't look all that hot. Doesn't mean it won't stop. But, really, I think we need to follow the consumer. If we see unemployment continue to rise, that is where you're going to have a bigger issue. But if you look at some of the not so common indicators, there is, Alan Greenspan, you mentioned him. His favorite one is the underwear index. And we talked about this a while ago. And I think, Brent, you got a really nice piece from Lance. We were talking about how you can actually put underwear on layaway. You have all these buy now, pay later programs. And what was that, his Jimmy John's piece?
Jimmy John's.
Yeah.
That's right.
Yeah. But does that change things because people now have a lot more ways to be creative as far as from a financing perspective that maybe some of these off the wall indicators aren't as great anymore? You look at women, it used to be the lipstick indicator. How often are they buying lipstick? I think that some of these may have changed just with the advent of a lot of ways that we can finance current purchases now. And so I think we're seeing a lot of that where it used to be, you saved, you waited, you didn't buy things, and now people say, well, whatever, I'll put it on a payment plan, no big deal. Does that change the game with some of these things?
I don't know. Maybe, because again, cardboard boxes used to be a big indicator for the economy, but again, that hasn't been a real big indicator either. But, you think about how much we ship in cardboard boxes just in Amazon deliveries every day. You'd almost have to think that there's some indicator there. But again, that's been weak. Underwear indicators, it's some of the stuff is so expensive. I don't know how people afford it. $40 for a pair of underwear. I'm just
it's crazy.
Yeah, it's nuts. So I think Commando's going to be in, for a while. But, again, it's just kind of, again, a lot of these indicators just don't matter because you have a very small group of stocks and a very small sector of the overall economy driving the overall economy and the markets.
Yeah, and that may be more of the conversation, honestly. I mean, if you look at a heat map and just go look at the market cap of NVIDIA, of Apple, of Microsoft, those three are bigger than any other international market in general from a market cap perspective. NVIDIA is bigger than the United Kingdom's stock market. And, it's like I had a discussion with somebody about Tesla yesterday. Tesla's market cap is so big that, if you look at it compared to Ford, GM, all the other auto manufacturers, it would suggest that none of these guys make any vehicles, really. I mean, everything is extremely expensive. So if you're looking at, from an investment standpoint, you could have just with these big mega cap companies, you could see a bigger drawdown or a bigger issue moving forward, even if those guys they stumble, which we've seen. And we saw that a couple of days ago where, most of the market did relatively well, but the tech was taking on the chin a little bit. But then, it's day by day, we're seeing it flip. And it's not so uncommon to see, quite a bit of volatility, but the markets remained fairly resilient if one of those companies is doing halfway decent. So what do people do when you're looking at that, especially when we see, 23 was a big year for tech, market breadth was terrible, 24 wasn't all that hot. 24 was much, much better. Market breadth had improved, but there were still times that, tech is certainly still driving the way. And you look at a year like this year, you're beginning to see it, in times that the whole market's participating, but we're still not quite there. Do you see or envision, Lance, a potential where tech gets a bigger pullback, or with all the investment into it, the kind of the renaissance, so to speak, in a lot of ways? Does that just continue for quite some time? And, you've mentioned this could be a 98, 99 type situation.
I mean, I don't know. Well, I mean, what do you want me to, who knows? Sure, it's absolutely possible, but nobody knows when. So,
Okay.
you're just asking the obvious questions. Is like, could this ever happen? Sure, it could happen, but that's the problem, is that nobody knows. And again, right now, when you have this circular relationship between, like I mentioned earlier, you've got CoreWeave investing $100 million into Oracle, which invested $100 million into NVIDIA, which invested $100 million back into CoreWeave. I mean, you've got that circular loop going on. The question is when does the SEC catch on to that and stop it?
Yeah.
Right? I mean, this was very similar to the stuff we saw back in 1999, but we didn't know that. I mean, that was going on in 96, 97, 98, 99, and we didn't know about it till 2000 when Enron blew up, right?
Correct.
So, yeah. I mean, it's you're asking questions that nobody has answers to.
That's what you're here for, to tell everybody the answers they don't know.
So I did think this one was because Danny brought this article in, and then of course he never actually gets to his own article that he brings in. I don't know why he sends me these articles, but he's talking about giant skeletons being an indicator, and I thought it was interesting because these giant skeletons, like at Home Depot, they're like 12 feet tall. People put in their yards.
Yeah.
So they're saying that, this has been one of the indicators that people are snapping these things up, and that's a sign of a good, when people have a lot of discretionary income, right?
Right.
They snap up stupid stuff for their
Money to waste.
Exactly. So they're buying these 12-foot skeletons. And what's interesting is they're kind of saying that maybe the sales for those aren't as much this year, so it could be a sign the economy is slowing down a bit, whatever. But my wife found one that she wants. It's just the upper half of the skeleton.
Uh-huh.
And it sits in the yard like it's coming up out of the ground.
Oh.
You have like a gravestone behind it? Or?
No. It's just skeleton.
Just
and so
skeleton emerging.
Yeah. Exactly. And so his lights, his eyes are LED lights, so they light up and change colors. Yeah. Costco, it's sold at Costco.
Yeah.
She has called Costco in Austin, every Costco in Houston, every Costco in Dallas, every Costco where we've got friends or relatives that live nearby a Costco to get one of these things and ship it to us. Sold out.
Christina is a woman on a mission.
She wants the skeleton, but she can't get it. So
And how much are they?
I have no idea. I don't look.
You don't want to know.
I don't want to know.
Well, it's amazing how expensive some of those things are. So
My little GD can get whatever she wants. You gonna ask me what GD stands for? It's my new nickname for
what is that?
genetic defect.
Oh, good Lord.
Oh, no.
She's my sweet little genetic defect.
I like that.
So
But so the ones at Home Depot, evidently, so an Iowa Democratic state representative actually said, usually you can tell by watching, the skeletons. Mm-hmm. And he said there's still 3,000. So maybe she's looking at the wrong one, but these are the 12-foot ones from Home Depot. There's still 3,000 available. And typically by now, those would already have been gone.
yeah, that's what I'm saying. It's like, maybe,
So how do you-
try to use these? But again, maybe just nobody wants the old 12-foot skeleton anymore because everybody has those. They want the new one where the eyes light up, like my wife wants.
Coming out of the
Can't
ground.
get those.
Yeah.
Exactly.
Interesting.
So
I don't know. I saw something.
But that's the problem with these indicators, right? People latch onto them like, McDonald's hamburgers.
Yeah.
How many Big Macs? The Big Mac index, right? I mean, that's a reasonable indicator because if people can't afford to go eat at McDonald's,
Yeah.
it's kind of a good indicator. But it's kind of lost its way in recent years because there's been points where the Big Mac index has indicated an economic slowdown, and then the economy keeps roaring along.
Well, I'm sure it does every January. And everybody gets in their, New Year's resolutions. Nope, no more Big Macs. And, 3 weeks later.
And they get their charge card statements in the mail.
Yeah, but I think that, we talked about inflation, Lance. I mean, some of the stuff's just gotten so expensive. Like, I wouldn't fathom buying half this stuff. I clicked on something the other day. It was like a ghost from Ghostbusters. Like, oh, the kids would get a kick out of that. Put that in the window. I was thinking it's like, I don't know. Maybe I'm just way off, $40, $50. It was like $300-something. It's like, that's ridiculous.
Maybe you're living in the 1990s.
Yeah, maybe. But maybe I don't want to
I
part
ain't
with,
afraid of no ghosts.
$300-something either for something that's going to stick in a window for however long.
But this is the whole point, right?
Yeah.
All that stuff is expensive now.
Yeah.
It's all expensive. And again, we talk about inflation, and yes, that stuff doesn't show up in the inflation index because it's not calculated in the inflation index. So when we talk about CPI inflation, it shows that the inflation is cooling. But I mean, there's a lot of stuff that is just hugely expensive that is never going to go back to the way it was, right? It's like
true.
Barbara Streisand and Robert Redford, who just passed away, the way we were. Ain't ever going back to the way we were.
Yeah, well, they're not going to give me for that. I can promise you that. But it is. I mean, think about that. You are literally buying junk that is going to sit in a storage unit or your garage for, 11 months out of the year?
Exactly.
Which is why my wife has storage bins labeled by season.
Yeah, mine does as well. We've actually been paring down. But so that's the question, is that are people going to begin to wake up and say, hey, we can't do that? You look at the consumer, we're at all-time high credit debt since October of 2023, yet they've continued to be extremely resilient. And, I would have thought they would have ran out of runway a long, long time ago. But evidently it's not happening. I mean, it's just continuing to go. And at some point, you've got to think that consumer confidence number has to continue to fall if we continue to see unemployment data weaken. At what point do we see that shift happen? I mean, I think that's a big question.
Right. Well, employment's doing fine. I mean, at this point, we continue to, run a low unemployment rate, even though, again, employment as a percent, full-time employment, which is the key driver of the economy, continues to fall as a function of those who are actually employed, or as a percentage.
Yeah.
So again, I mean, we're definitely seeing employment weakness, but it just doesn't show up in the headlines because of the way that we calculate employment data. And then this is the problem with all of our all the kind of government measures. It's always comes down to the way that we calculate it. And, all these things look fine. But again, if you start shifting through to real-time data, start looking at actual kind of measures, there's 110 million people. So the U.S. economy is about 340 million people, give or take. 110 million of those people are not employed. And we don't even count them in the employment numbers. So there's 110 million people that we just don't count. That's 1/3 of the economy that we just don't count.
Yeah.
So what are those people doing? Right? Yeah, I know some of them are in school. These are, by the way, these are 16 and over, right? So 110 million Americans, 16 and over, where are they? Yeah, some are in school, get it, right? Some are retired, get it, yep, right? But there's a whole lot of people between 25 and 54 that we just don't count.
They're just out of work.
Well, they've fallen off the rolls, and so we don't count. They may be working, right? They may be being DoorDash drivers or Uber drivers or whatever. But they've been out of this. If you work 3 part-time jobs, as an example,
you're not going to be in the system.
You're not in the system. You're not counted, right? So multiple part-time job holders fall out of the system. So we've got a whole bunch of the economy that we simply just don't count.
Yeah.
But we have data for that. We could call Uber and say how many drivers you got. We could call Lyft, how many drivers do you have? We could call DoorDash, how many people you got working for you. I mean, surveying these companies that have massive employment bases, we give you a much better real-time indicator of what's going on with employment.
But don't you think the biggest real-time indicator would be the IRS?
Sure.
I mean, they have all the data.
Yeah, they have payroll data.
Yeah. I mean, we look at, ADP, you could look at paychecks, you could look at a lot of different things, but yet they still use, for the most part,
surveys.
An economic survey.
Phone surveys, at best.
Yeah. And how many people pick those up?
Yeah. Well, and the only issue with, the IRS is that you'll get biweekly W-2 payroll income, right? But you miss out. It's not going to catch independent workers that file 1099s annually.
Yeah.
So you'd have so the problem with the IRS data, and there's a lot of people that promoted that. There's a lot of W-2 workers that would give us a really kind of good real-time indicator of what's going on, but there's a big chunk of the economy that work on K-1 or 1099s that only file at the end of the year. So they're taking distributions, but they're not filing. So again, you only kind of get quarterly updates when they make estimated tax payments, but then you have a big annual revision to the data every year when you catch all those other workers that come in.
But you would think that would be better than, say, ADP even.
No, ADP would be better because ADP functions as, they cover a broad swath of industries.
Correct.
They measure who's working part-time, who's getting laid off, who's getting terminated, who's getting hired. And again, you'd have to, use ADP, Paychecks. There's multiple payroll companies, right? But you could just pull data from all those payroll companies. And even those payroll companies handle the 1099 payments. So you would capture some of that 1099 data even through companies like ADP and Paychex. So it would give you a better feed than the IRS.
Yeah. No, that makes sense. I mean, so if you're looking at employment data as a whole, we are seeing it it's declining some.
Yep.
But not yet to that mark where we're saying, hey, big trouble ahead.
Yeah. And I mean, the comment, and then Chaz right too, is like, you need to know how many active gig workers there are, because there's a lot of people that are working gig jobs that, we just that don't get counted as well.
Have you taken an Uber lately?
Nope.
If you had.
I was taught when I was growing up to never get in car with strangers. So I drive myself.
You drive yourself. All right.
Yeah.
Well, if you ever do, I always find it fascinating talking to these people, because you find out like this is probably not their only job. They've got many different jobs, right? And how many of those guys are counted in general just because they're doing, 20 hours at Uber, 20 hours here?
Oh, no. No, I did that when I was in Florida. I was on a trip, and I got into an Uber to go from one place to go back to the airport. And so the Uber driver also drove for Lyft. And when he didn't have a Lyft job or an Uber job, he drove for FedEx. And if he didn't have one of those three jobs, he was a mobile mechanic, and he had all of his tools in his trunk, and he would just go help people on the side of the road. So he had 4 jobs that he was running out of his car.
How do you manage that? So when do you stop and say, wait, I'm going to go FedEx?
That was my question to him. I was like, you must be really well organized. And he's like, yes, I am. I have to be very well organized. But he knew exactly, because FedEx, you just work, you go, you pick up a bunch of packages, and you drop them off in the morning. So that's like a 2-hour gig, right? Okay. So he had that in the mornings. And then he would drive Uber and Lyft. And in between Uber and Lyft rides, he would do mobile auto mechanic. So, but he had his act together. But again, that's a very creative guy that was probably working a bunch on cash, like the mobile auto mechanics. I'm sure he's working mostly on cash deals, like, I'll come change your tire, $50, whatever, pay me in cash. That didn't get reported. But again, he's working 4 part-time jobs, which means he's not counted by the labor department.
That makes sense. I had a flat on one of the highways not long, well, let's say not long ago, several years ago. And I was like, I'm not changing this on the side of this highway. So I called, OnStar, AAA, whatever it was, and they sent somebody, but it was literally just this dude out of his car.
Yeah.
He comes out, brings out, like, you'd have thought he was like a NASCAR, one of those guys that switches tires. He was that quick, but, he had the big jack, came out and just zoop, zoop, zoop. I mean, he was done, and I bet a minute flat. 'Cause I was like, I'm going to get ran over. Like, I was nervous sitting in the truck.
Yeah.
And this guy came out and did it in no time. But I was like, I thought I was waiting on a wrecker. And this guy comes in, a Delta 88 Oldsmobile from, 1987. And I'm like, oh, man, I'm about to get robbed. He pulls this thing out. I'm like,
well,
oh,
at least
crap.
it wasn't a DeLorean, but there you go.
Yeah, I don't think a jack would have fit there. Not this guy.
No, but again, this is the problem with all these economic indicators. So again, you take a look at these economic indicators that suggest, hey, the economy's near recession. Again, there's a whole lot of commentary out there right now saying, hey, the market's on a verge, the economy's on the verge of recession. What's that mean for the stock market? And that has a big impact, because a recessionary drag on the economy is going to impact earnings. And if you have a large, drop off in economic activity, that's going to even impact technology companies to some degree. So again, all these expectations that are around these earnings growth rates, we're expecting 13 to 17% earnings growth next year for the markets. That requires fairly strong economic growth, because somebody's going to be buying the products. It's okay that you've got this circular kind of investment between companies right now. That's okay, but that's not generating revenue. You need to sell a product to generate revenue. And so if the economy is slowing down, you are heading to a recession, you are going to have a problem with forward revenue, forward earnings. That's going to be problematic for markets that are trading at 23 times forward earnings.
But does that even matter if they continue to lower the bar? I mean, every time, we get to forward guidance, so it's going to be X, and then, every analyst comes out and with this great frothy view, and then inevitably, they begin to walk that back right before earnings. So the market, for whatever reason, doesn't seem to care outside of as long as they're saying, oh, things are good, we're doing well, here's what we expect. And even if it's not that, most of these companies are still beating.
Well, yeah, because you lower the bar, right? This is why we call it millennial earnings season, because everybody gets a trophy. But yeah, you gradually lower the bar, right? It's kind of like boiling a frog in reverse, right?
Yeah.
So you start out with earnings really high, and then you just kind of gradually lower them as you get towards actual earnings, and then everybody can beat the bar, right?
Yeah.
But nobody pays attention to the estimate revisions, because everybody's kind of focused on how many companies are going to beat their earnings. Well, if I can lower the bar enough, everybody gets over the hurdle, everybody gets a trophy, markets are great.
Yeah. Now, you did a report years ago. Have you done anything recently where you actually looked at all the analysts and said, buy, sell, hold? You remember that one?
Yeah.
Yeah. And it was
It's the same.
nobody does.
Yeah.
Nobody ever says sell.
Out of 5,000 stocks, 4,600 of them are buy rated.
Yeah.
Right. And you've got maybe 300 or 400 that are hold, and you've got virtually no sells. And again, there's no, why would if I'm an analyst working for a company, I'm doing investment banking for that company, why would I rate them a sell? That's not going to, the corporate.
Yeah, there's so many conflicts of interest within that.
Yeah. I mean, the executives of the company are based on stock option based compensation. So if I, say, hey, this is a sell rated company and the stock price goes down, they don't get their compensation. How long do you think they're going to do business with me?
Yeah.
Right. That's why there's no sell ratings.
No, they're not. That's exactly right. And that's the problem, I think, with the conflicts that are there with the big firms that are doing the M&A, doing investment banking, doing all the lending, doing, all the different aspects of it. There's no way that one of these guys can put a sell rating on any of these because they're going to forfeit all that business. Mm-hmm. Now, so the Trump administration has floated out doing reporting every 6 months versus every quarter.
Yeah, we talked about that yesterday some.
Yeah, what do you think of that? You think that's a good idea?
Yeah.
You do?
Yeah.
But so years ago, the IMF made China begin to report because they were doing it on an annualized basis quarterly so you could get a better idea as far as the trend. You don't think that kind of negates the opportunity to see a little bit quicker as far as what corporations are doing?
No, we talked about this yesterday, is that actually the better way to do it would be for them to report annually.
Yeah. Interesting. So going all the way back.
Because you wouldn't game the market.
Yeah.
And plus, it's a huge cost for corporations. It's a very onerous cost on corporations to report quarterly.
Yeah.
So you would have better profitability for companies, and plus, how much time and manpower are you draining every quarter just to report earnings every quarter? We just finished earnings. We're about to start earnings next.
You're getting ramping up for
right?
it. Yeah.
So how much manpower and time am I wasting as a company rather than focusing on my business and products, just getting ready for earnings announcements so that I can beat some lower estimate bar, so that my stock price goes up, rather than having it just once or twice a year where I can go do my business, run my business. I can give quarterly updates to my investor group, right?
Yeah.
I can have conferences, whatever. But then just do an annual filing, and that way, you know what the business is doing.
No, that's true. I mean, if you look at it that way, but wasn't that invented in 1934 after the Great Depression so that we could get a better idea?
You tell me, you're the one throwing out the stats.
Yeah.
Okay, there you go.
Oh, man. I love it when Lance comes to play. He's like, no, whatever.
Well, I mean, you're asking me, you're like, wasn't that invented in 1934? You have the stat in front of you. Just tell me it was invented in 1934. Okay. And don't ask me questions I already know the answer to.
All right.
But it is interesting. Somebody just in chat just said, wouldn't it be interesting if we went back to the lows of April? And that would actually be a decent correction from here.
That'd be a tremendous correction.
Yeah, it'd be about 25% from here. And he's right. So just and that would just be like, and this is the problem with the markets. They've gotten so extended now. Can you imagine if we corrected back to the October 2022 lows? Right, and that's still massively higher than where we were back in 2009. The market's up 1,000% since the lows of 2009. We were at 666, and the lows we just crossed 6,666. So you've had this massive surge in the market, 6,000 points, and just correcting back to previous levels now, it's going to require a much bigger drawdown.
So you think that reversion is going to be much larger now?
No, I don't think that at all. I'm just saying is just to go back to the April lows, just where we were in April. Can you imagine if we did that? I mean, you're having a 25% decline. People are going to be losing their minds. Like, oh my God, this is the next major crash. Michael Pinto was talking about last year, we're going to have a 50% correction in the markets. Well, 25% gets you to April lows, right?
Yeah.
So, wow, that's devastating, right? I'm all the way back to where I was in April.
Well, it is devastating because you've had all these people between here and there who've probably gotten a lot longer in their positioning.
Sure.
And, that anticipation is going to continue. And then you think about this. I mean, we have conversations that, people are concerned on, hey, do I not have enough exposure right now? We're going to continue to have this melt up. And that's where I think you mentioned earlier, people get sucked in. And my question is always this, is that, all right, 20%, that's great. Is that going to impact your retirement significantly? It's going to change your life? Probably not. But a 20% decline in whatever you have can certainly do so, especially if you didn't have that opportunity to ride that wave all the way up, which many people didn't do. And, we look at the markets, but everybody forgets the math of loss, exactly how money works. So we're working with much less money because we've already had a big drawdown. Unless you had cash on hand and you put those funds to work, the math just doesn't work as well. And so at the end of the day, when you're looking at, how do you navigate this long term, I think that there's a significant problem maybe in mindset that, we need this extra little oomph because we didn't save enough. So we're going to go ahead and take this additional risk, where that risk reward is not always in your favor, especially when markets are where they are. Now, that doesn't mean that they can't continue to go up, but I think, the higher you get, the odds of a bigger reversion are certainly much greater.
Yeah. And again, Brent, show this chart for me real quick. Just the blue line's all I need. But I mean, when you look at markets that are virtually going literally parabolic, and this is always kind of the interesting thing in markets. You've got a market that's going virtually parabolic right now. It's just literally going straight up, and that is unsustainable to any great degree. You've got MACD indicators and relative strength indicators at massive extremes. Now, if I showed you this chart, what would be your statement about the market?
Very overbought.
Right? And would you be concerned about that?
Absolutely.
Okay, that's gold miners.
Yeah.
Right? That's the hottest chase in the markets right now.
So that's GDX?
That's GDX.
Yeah.
Right? So that is the hottest chase in the market. And so when you take a look at, valuations, it's always interesting. Everybody sees a bubble in asset prices, and there's, the S&P is so overvalued, but they don't see bubbles in every other asset class. But you've got bubbles going on right now in virtually every single asset class, whether it's Bitcoin, gold miners, stocks, emerging markets, small caps, mid caps. You've got bubbles running everywhere, and people are just chasing the most speculative names in the markets.
So when do you see that pure sector rotation? We've talked about large cap value, fundamentals haven't mattered in so long.
The problem when you have a sector rotation, it's going to be into cash.
Yeah.
And bonds.
So you don't think you see it if you see interest rates decline, you don't think you see utilities, more consumer defensive staples?
They've already run.
Yeah.
Everybody was chasing utility. Look at GE Vernova and Oklo and other utilities.
Yeah, utilities have been interesting.
Constellation Energy. This has been the whole bet on the AI data center build out. So those stocks are overvalued.
Yeah.
So yeah, that's the problem, is that there's not a lot of safe places to hide in the markets. And when you get this rotation to risk off, it's going to be across asset classes, which is it's going to be very reminiscent to what we saw in 2022, where you had that risk off rotation and nothing worked.
Yeah. Well, that's scary because if nothing works, I guess maybe hopefully bonds work. 2022 was an odd year that bonds were hit as hard as they were. So maybe at that point, if you see everybody moving out because the economy slowed down enough and you see interest rates actually coming down in earnest. But, do we see the market get spooked by interest rates anytime soon? I mean, it seems like the Fed is they've got a pretty big divide right now. Do you think that they come out and cut, substantially, or is it just going to be kind of 25 here, 25 there, and probably sit back and wait?
Yep.
Okay.
We'll see.
Well, that we will.
All right. That wraps up the show for the day. Be sure and get by the website, realinvestmentadvice.com. Get our latest blog post. Michael's article is out this morning, and it's talking more about the markets and what's going on. But it's a really good piece. It's worth a read. It's on the website right now. Also, our daily market commentary is out this morning. I posted it already to Substack. So at Lance Roberts on Substack. It's also posted on X at Lance Roberts. Easy to find. Also on the website, front page, realinvestmentadvice.com. All right. Be sure and like and subscribe to the channel. Appreciate it very much. We'll be back tomorrow with Michael Leibowitz talking more about interest rates, Fed Powell yesterday, his comments, what that means for the markets, and really this outlook for what's happening within this structure of the markets as well. That's coming up tomorrow with Michael Leibowitz. Have a great day.